The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're thrilled to be joined by Ella Rabener. Ella is the co-founder and chief marketing officer of Scalable Capital, a technology-driven investment management platform for retail investors. Scalable Capital has raised 41 million euros in funding from BlackRock, Holtzbrinck Ventures, and Tengelmann Ventures. Scalable employs over 50 people in offices in Munich and London. I think this is one of the most interesting conversations we've ever had on the show. It's a bit long, but it's highly worth listening to through to the end. Ella drove this discussion across a range of topics, including raising a 30 million round led by BlackRock, what she learned in 8 years at McKinsey, what we can do to address the gender imbalance in the workplace, and what the future of investing will look like. We've gotten some great feedback from you guys, the audience, over the past few weeks, which is helping us shape upcoming episodes. Keep getting in touch. Email us at rebank@bankingthefuture.com with ideas or just to introduce yourself. We love hearing from you. Special thanks to Innovate Finance for connecting us with Ella. We're hugely appreciative of everything you do for fintech in London. Thank you very much for joining us today. Please welcome Ella Rabener. Ella, welcome to Rebank.
Thank you. Thanks for having me.
Tell us a bit about Scalable Capital.
So Scalable Capital is a digital wealth manager. And what that means is we manage people's money for them, typically for retirement, but also some of our clients might have other goals like buying a house, funding their children's education. And we really take care of everything for them. So we help them to define what risk category is the right one for them. And then we manage their investments over time. And we monitor markets with our algorithm, basically. And we then make adjustments to their portfolio as we go along to make sure that their portfolio always matches their risk preference. And we do all of that at very low cost. And it starts from £10,000, and you can set up monthly savings plans starting from £50. So we really make a very professional way of wealth management more accessible to a much larger group of people.
So in different countries, there are kind of different takes on the digital wealth management slash robo-advisor. Don't know how you feel about that term. Kind of business model. I mean, what is it that makes Scalable Capital distinct?
That's a very easy answer, actually. It's our risk management technology. So we really focus on using technology not just for what we would call the packaging of the product, so an easy onboarding process, an app where you can track real-time performance and so on. But we really want to use technology to make the investment process better. So to basically offer a smarter way or a smarter investment management process to people. And really a process that in the past was only available to institutional investors that had portfolios of billions of pounds, basically, to manage and to invest. And what that really means is what I mentioned earlier, basically. We monitor every individual client portfolio because we're not using model portfolios. We use individual portfolios for every client. We monitor those portfolios every single day. And we analyze through our algorithm the level of risk that is currently today in your portfolio. If it doesn't match your risk category any longer, we will make an adjustment to make sure that we bring it back in line. And we basically run that process every single day. And that way we make sure that people don't have these nasty surprises, basically, where they invest into a fund, for example, that is called moderate risk. And then they have a certain assumption what that means in terms of what potential loss could I have in a really bad year in that portfolio. And then all of a sudden they discover that their portfolio is down maybe by 30%, and they're very unhappy, and typically they sell and get out and don't invest again for another 5 years or so. So instead of that experience, we want to make it very transparent to our investors what the level of risk is in their portfolio, and then to also keep it at exactly that level in all market environments.
Mm-hmm. I mean, there's this investment management concept of the portfolio rebalancing, which is probably pretty dull for most people, but basically the concept that if you, I don't know, start with a simple 50% equity, 50% bonds split, and then you happen to be in kind of a bull equity market, next thing you know, you're actually 60% equity, 40% bonds because your equities have outperformed, which means you have a riskier portfolio now than you did when you started. And if you don't rebalance it, then to your point, you're kind of getting away from what your expectations are.
Yes, that is completely right. But what you're describing is actually a very traditional way of managing money and a traditional way of rebalancing, where you basically use your asset classes as a proxy for risk. So you basically go in with the assumption that equities, for example, are always more risky than bonds. We actually are agnostic to these assumptions. We basically say sometimes bonds can actually be more risky than equities. It depends on what market environment you're in. So we don't look at asset classes with that preconception of how much risk they're supposed to have, because risk actually fluctuates. So while you can say on average equities have higher risk than bonds, there are periods in time where that's not true. And there are also periods in time where equities have twice as much risk as they normally have, or as they have on average. So instead, we look at the actual data. So every day we look at how volatile, how risky is that particular asset class today. And we also look at what's its relationship to other asset classes, so correlations in other words. And based on that, we calculate a number which is called value at risk, which is a risk measure basically. And then we make sure that that number stays constant over time. So while we also rebalance, we basically don't use static weights saying, oh, we always want you to be in 50% equities, 50% bonds. Instead, we would say we want you to be in exactly that allocation that gives you the risk level you want. And for that basically first means a likelihood of loss that you feel comfortable with. And we want to maintain that.
Is it expensive to do that daily reallocation?
It used to be very expensive, which is why in the past only institutional investors had access to it, because you needed to have mainframe computers, which the big investment banks obviously had, and then you would have to do a lot of number crunching, and it was incredibly expensive. And it just would not have made sense to do it. In the past, you even would not have been able to do it for a £5 million portfolio, right, without charging excessive fees. These days, though, we've got cloud computing, and obviously the cost of computational power has dropped exponentially. And this is why this is exactly the right point in time to start offering this to regular retail investors and make it more accessible, because we can do it without high fees. So we charge 0.75% per year, which is very much in line with what other robo-advisors or digital wealth managers offer, while I believe that we offer something that is more sophisticated.
You guys recently hit £500 million in assets under management earlier this month, I think.
Yes,
congratulations.
that's correct. Thank you.
Presumably that's a big milestone for you guys.
Yeah, absolutely. Reaching the first $500 million is a big milestone. Obviously, the billion's gonna be an even bigger one. But I think what you can see is that your growth really accelerates over time, right? Because managing people's money requires confidence and trust, and you don't get that overnight. It takes time to build it up. And now that we've reached $500 million, I think it will help us to reach the billion even quicker, because people now have that trust. They can see, they already manage the money of more than 15,000 clients, which is probably as important a number as the 500 million. And it gives people the confidence that they can give us their money and they're in safe hands. And I think related to that, the trust building factor is our cooperation with ING DiBa in Germany. It's Germany's third largest retail bank. It's been voted Germany's most popular bank for several years in a row. And we are deeply embedded into their infrastructure now. So they are offering our service to all of their customers in Germany. And there was a lot of press coverage about that as well. And I feel that a lot of customers thought, they've been watching us for some time and they weren't 100% sure because we were still a startup after all. And now they feel, oh, wow, if one of Germany's largest banks cooperates with them and very proactively promotes their service, then it's the right time for me now to get in because I can trust them.
Yeah. No, that's interesting. And I guess it kind of, in a way, brings me to a question around viability of business model longer term. Mm-hmm. And I think there's been some concern after some initial kind of euphoria around this concept of robo advice and how now you're getting all your investments managed for some small number of basis points as opposed to percent per year. but some of the early players, maybe specifically in the U.S., the wealth fronts and betterments of the world, Nutmeg here in the U.K., a lot of the kind of external thinking is that they may be having difficulty raising the sorts of or the sizes of assets under management to support that very low margin business. Effectively, it's a volume play, it's a scale play. You've seen some of the U.S. robo-advisors move in slightly different directions, hiring brokers for more bespoke services for certain customers, moving away from that core of purely automated, super low fee investment management. Maybe you guys are pursuing more of a bank partnership, B2B to C type model. Not sure. I mean, how do you guys think? Well, firstly, how do you see the market broadly and kind of that original model of huge AUMs, low margin? Is that sustainable? And two, how does that influence your thinking?
So I think my first point would be that there is a reason why we are offering lower fees, right? And that is because we know that we are operating at much lower costs than most of the traditional players. So I think just saying, oh my God, these guys offer low fees, therefore it's going to be incredibly hard for them to be profitable, it forgets the other element of that equation. When you look at gross margins, in the end, it's not just determined by your revenue, it's also determined by your cost, right? And yes, we charge less, but our costs are also lower. And I think for them to be lower, you obviously need to automate whatever you can within your organizational structure, right? And that is exactly what we are doing. So we believe that everything that can be automated will be automated as well, which is why we've set up our investment process in a very automated way. So while the recommendations of the algorithm are still being reviewed by our team, so there's no automatic trade execution, basically, there is a human quality check. We don't fiddle with the outcome of the algorithm. Yeah. And we also don't want to do that because we don't want to hire a big team of researchers and analysts and so on. So we believe that we need to be extremely lean as an organizational structure. But having said that, of course, you need the right level of AUM in order to become profitable at some point. I've been asked the question very often, how much do you actually need to be profitable? And I think that really depends on the individual robo-advisor, their model, how lean they really are, how much of a technology focus they have. And I think it also depends on whether or not they've got external partnerships. Because I think with external partnerships, you can also reach higher AUM levels quicker, but you obviously also have to share revenue with another partner. So you might need a higher level of AUM, but it might be easier for you to get there than if you pursue a pure D2C play model. In the end, I believe that we will see some of the robo-advisors fail. Like in every new sector, basically, where you have lots of market entrants. If it's an attractive sector, and I believe ours is an attractive sector, you will see some of the companies fail. But I also don't think that it's a winner-takes-it-all model. It's the same as banking, right? It's not like we've got one bank. It's not an eBay or an Amazon kind of play where you feel like one player will be able to attract an incredible amount or an incredibly big slice of the pie. I think we will see in each country, 5 to 10 players potentially even succeed. But our view is that partnerships with existing players are extremely powerful. They help you grow AUM. They help you gain that trust from customers that I just spoke about earlier with regards to our ING DBA deal. And since we see ourselves as a technology company as much as a financial company, we have the technology to help many different kinds of partners, and we are very much pursuing that strategy as well, while maintaining D2C in order to make sure that we are, close to customers, we know what they want, and we can have the best features available for them.
We've seen players like Schwab and Vanguard either launch robo-advisory services or slash margins to compete. Will startups or incumbents in this space win?
I think both will have good chances at gaining customer traction. I believe that the incumbents will have to move because otherwise they're going to lose customers. They obviously have the big advantage that they do have reach already. They have distribution power, right? But it's not always a given. Just because you have a lot of customers doesn't mean you will always have them, and customers will be forgiving if you don't offer great services to them, right? So I think there is pressure on the incumbents to change their models because obviously there's been a lot of negative press about the financial sector as well. And while people maybe trust an established name more with managing their money, it doesn't necessarily mean that they always like financial companies, right? So I think you need to make a move. You need to become more transparent. You need to become cheaper. You need to offer more individualized services as well. So I think there is a lot of pressure on the incumbents, but some of them will make the right moves. And I think it's a chance for them to capture even bigger market share. And also I think the whole market size could become bigger because we still have 80% of ISAs going into cash every year in the UK. So if all of us together can move way more of that money into an invested portfolio, then the whole market is going to grow and it's going to create more room for all of us, basically. But then coming back to the startups, I think there will be quite a number of startups that will also be able to survive. And I think one of the biggest benefits that you have as a startup is that you can be very independent in how you build your portfolios. If I'm an asset manager, I will always have a very strong incentive to try and build portfolios only with my own products, even if it's not in the best interest of the customer, because there will be huge internal resistance in the organization to basically say, oh, let's also use our competitors' products because they're better. Like, I can hardly envision a big organization doing that, even though it would be great for the customer. Whereas we at Scalable, basically, we look at the ETF universe. There are 1,500 ETFs out there in the UK you could buy as a retail investor. Incredibly hard choice which ones to buy. We have built a separate algorithm that checks every day what are the 15 best ETFs we want to use. If we find a new one that looks better than what we currently have, we will exchange it for our customers. And it's 100% independent. And I think that's something that our customers really appreciate. And some of the existing players will struggle with that independence element, I believe.
Obviously, the institutional community likes what you guys are doing. You raised 30 million euros from BlackRock earlier this year. How has that impacted your business?
So first of all, let me just correct that slightly. So it was a 30 million rand, and BlackRock was one of the major participants in there. But there was also money coming in from our existing investors in that round. So, I mean, it's obviously helped, again, to build trust tremendously, to have BlackRock, the world's largest asset manager, as a backer and as an investor. So that helped a lot. It has also helped us with building or with opening doors for potential B2B2C partnerships. And this is also the rationale on BlackRock's side for that investment. They are interested in our technology, and they want to be able to go to their institutional clients, which could be banks, asset managers, insurers, whatever it is. They want to be able to go to these institutional clients, and they want to be able to offer them a technology-driven solution for the future to better serve the needs of their customers with regards to digital wealth management. And they've gone through, I believe, a very extensive review process and looked at many different digital wealth managers in Europe. And they have selected us, which is fantastic, because they believe that we've got the best technology out there in order to fulfill their purpose. So we are very proud of that. And so far, the partnership has been working extremely well.
Last week, we caught up with Fiona McKinsey of Marble, who, like you, was named one of the most powerful women in fintech by Innovate Finance in their recent Women in Fintech list. So congratulations.
Thank you.
And Fiona and I chatted about, I guess, some of the challenges or maybe, simply kind of the state of the world of fintech when it comes to gender diversity, specifically gender diversity. I'd be interested to get your thoughts too. I mean, the facts are pretty clear, whether it's UK fintech or startups generally, it can be overwhelmingly male-oriented. Why aren't there more women working in fintech? Do you feel the finance and tech industries disadvantage women?
I actually don't think that it's the industries themselves or the people working in the industry that disadvantage women. I think even the opposite is the case. We would love to have more women. And honestly, also all the other companies that I worked with previously, so whether it was in consulting, I was at McKinsey for almost 8 years, we were really trying desperately to hire more women at McKinsey. We just didn't get enough applications. It was the same at many, of my financial clients that I worked with at McKinsey. So that's already like 9 years ago or so. And it certainly hasn't changed at all, quite the opposite. And also my e-commerce startups that I ran before I joined Scalable as well. We tried to hire more women. But honestly, one of my co-founders, for example, in my previous startup, who was our CTO and had a degree in computer science. He studied in Munich. He told me we were like close to 300 people studying in my semester, basically, and we had maybe 7 women sitting in the auditorium. And when you look at that, then it's not surprising that you're not going to have a lot of female software engineers, right? We are recruiting primarily software engineers right now because we are so tech focused. And I can see, because I'm on our jobs email list, basically, I can see the number of applications coming in, and it's very rarely women. So while in my department, so I'm responsible for everything with regards to marketing, design, communication, and so on, customer relationship management, I actually have a majority of women in my team. But when I look at the software or financial engineering team, it's not the same. And it's not because we wouldn't like to have them. It's because they don't study those subjects, they don't have an interest in the subject, they often don't bring the right, previous professional experience to the table, and so on. And I'm participating at an initiative called Inspiring the Future, where you can go to schools regularly and speak to students there about the future and what they could do with their lives. And you try to inspire them. And I was at a school just last week, and I had 15 girls sitting there, about 16 basically in age. And I asked them, does any one of you want to pursue a career in a more technical or analytical field? With biology, physics, math, software engineering, these typical STEM subjects, basically. Not a single one of them was interested. And I mean, I can only speculate what the reasons are, but I think also in the press, I feel like the women's magazines are just still way too traditional. Like, they write about, yes, we should be strong women, we should be independent, we should have our careers, but I don't think that they proactively cover subjects such as, finance or computer engineering, and why these are great professions for women as well to work in. I don't think they proactively cover it. It's too much focused on beauty, fashion, lifestyle, celebrities, whatever. I just don't think that girls get inspired by the media to work in those professions. And then it's not a surprise that in the end, fintech companies end up with fewer women than men.
What was your experience like growing up? So from this perspective, I mean, did you have an interest in STEM at any point?
I think.
If so, how did you pursue that? And if not, why do you think not?
I think I have the benefit of having 2 older brothers who were very good at math and physics, and my father was a computer engineer as well. So I guess I grew up in an environment where you had to be relatively analytical to be taken seriously in my family. And I ended up at school age, actually, I ended up majoring in arts and math. And then I was it was a bit schizophrenic, sort of, in terms of what do I actually want to do? Do I like the whole design and arts area? Or do I want to do math? Because I really like math as well. For me, math was always just like solving a riddle. It was kind of fun because when you managed to do it, it was rewarding, sort of. And then I ended up somewhere in the middle, basically studying management for some time. But also there, what I liked most was math. This, solving a problem, and then the satisfaction of having been able to solve it. I always liked that. Mm-hmm. So I think, and that helped me through my entire career. And then somehow I ended up in that whole finance section or area within business administration or management, because that was the most analytical and mathematical area of them all.
And I mean, was that interest in problem solving, was that something that you shared with other female friends of yours when you were growing up? I mean, was that like, was there a forum for in which you could kind of pursue that openly, or was it
Not
kind of more
much,
in your
actually.
family and in the classroom?
Yeah. I think I even and I think things are changing now, but when I was a kid, like when I did my A-levels like 20 years ago, so I still remember that I had a teacher in my last 2 years where I majored in math, and in that subject, in that class, basically in the beginning, he had never taught me before, so he hadn't seen me as a student before. And I remember in the beginning that whenever I raised my hand to basically say something or because I had a solution to the problem, he just wouldn't call on me, basically because he thought I wouldn't know. Probably because I was a woman, He would always call in some of the boys in the room, yeah. And then just over time, after a couple of tests, he basically realized that I also knew some stuff in mathematics, but you always hit that preconception. You always have to first prove people wrong, basically, because the ingoing assumption is, oh, also I'm blonde, which also probably then doesn't help, then they have this conception, oh, she's that blonde girl, like she's probably not going to be good at math. And that really annoys me. But it's also hard to change if a lot of girls still fulfill that cliche. Right?
Yeah, I mean,
because they feel it's fine to not be good, or it's even cool to not be good in math, and it's not cool.
Yeah, 100%. I wonder where that stereotype comes from. Like, I don't know.
I think a lot of it is still parents as well. Yeah. I guess. I mean, I can't judge anyone in particular, obviously, but I guess that many parents are just more forgiving. Basically, if their girl is doing great in languages, but is not good in physics and chemistry and maths, I guess they are more forgiving, and I guess they just intuitively assume that their boy is going to be better in those languages, and then maybe they're more forgiving if their little boy is not great at languages. I still feel that it's difficult to get out of these stereotypes and cliches, and a lot of it is still happening subconsciously. I'm pretty sure about that.
So clearly, in your view, the kind of the fintech and the tech gender imbalance is more a societal issue than it is, poor hiring practices per se at individual companies.
In my experience, I would say so. I mean, obviously, I don't want to say that there aren't companies out there, that are very male dominated. Maybe also some of the more traditional companies where, at the management level, you have, a lot older people that maybe have even more, stereotypes in their minds. So I don't want to talk about, all the companies out there. Basically, I can't speak for everyone. But in my experience, I would say that the bigger problem by far is just not getting enough applications from women for those particular roles, rather than, bad hiring practices or a bias against women. Yeah. I mean, whatever I've seen over the last couple of years is actually rather a bias in favor of women. Sort of a desperation to try and get more obviously still qualified, right? But qualified women for certain jobs. Also for non-executive board positions, I think there's a huge push now to have more women there. So that's what I'm seeing. I think it's just that, more younger women, I think, need to realize that there are very attractive jobs out there in slightly less traditional areas, maybe that they would not have considered in the past, but that they should be considering now. Mm-hmm.
You mentioned the active work you're doing to encourage young people and it sounds like women specifically to be open to these sorts of pursuits. What can people be doing to kind of drive this sort of change that we desperately need?
So I think there's a huge role obviously to be played by parents and teachers as well. And I think if you're a parent, I would just encourage you, if you have a girl, just make sure that she sees the opportunities that are out there. Make sure that you don't just, push her in one direction. But for example, you encourage her to sign up for courses like, Girls Can Code and stuff like that. Just if they then decide it's not for them, it's obviously not about pushing women into areas they don't want to be in. It's about creating choice, right? But I think opening their eyes to what's possible and trying very consciously to avoid those stereotypes and those cliches, I think that's something, and again, also on the side of the teachers, obviously, I think that's going to help a lot, because we can do things afterwards, basically, as people have entered the workforce. We can set up mentoring programs and all of that. But, the groundwork is really being done while people are in their youth, I believe. So I think that's where most has to happen. And then obviously the media needs to play a role. And I think we just probably need more editors at girls' magazines and so on that try to proactively push those topics and try to encourage interest in other subjects as well, in girls, by showing them, exciting jobs, women that have achieved exciting things in their lives that are not a fashion blogger and not a model or an actress and so on. So try to make it very transparent or very easy, basically, for girls to understand what exactly can I do if I study something that's sort of a more technical or analytical subject. What exactly could my life look like? What does it allow me to do? I think women also still often underestimate how important it can be to earn the right amount of money in order to be financially independent, because we all have this idea these days that we want to be financially independent, But there's a consequence to that as well, right? You need to be able to afford that as well. And the bigger the gap is between your salary and your husband's salary later on, the more likely it's going to be that you are going to be the one who stays at home once you have children. And that often also means that you're going to miss career steps that are important, that will increase your salary again, and so on and so forth. And I feel that a lot of girls just don't think about that at all.
You mentioned you spent 8 or 9 years at McKinsey. I mean, at an organization like that, so, outside the world of technology, when you think about, promotion and, senior management of a firm like that, I mean, I suppose don't want to make assumptions, but perhaps there were more men in management positions at a company like that than women. And if that's the case, why do you think that is?
And you're right, obviously. So when you look at the senior partner level or even the partner level at McKinsey, you definitely have way more men than women. So I think it starts at the analyst level, where you definitely have less than 50% women, which again is not because of hiring biases, basically, but it's because McKinsey gets less applications from women. At least they used to when I was still there. I can't talk about today, but that used to be the case. So it starts there, but then it becomes worse, basically, along the hierarchy levels. And again, it's not because women don't get promoted. It's typically because women drop out out of their own accord, basically. And what I've seen quite often is when we had women's events internally at McKinsey, is that you get questions from women about, what do you think about me moving into an internal role? So not a client-facing role anymore where you can become a partner, but an internal role like in a research department, for example, at McKinsey. Even if they don't have children yet, for example, they're already thinking about how can I make sure that I'm in a job where I can very easily, juggle my career with my kids. And sometimes I feel like they are taking themselves out of a really good career path that they are on, even before they have children, right? And I'm sometimes a little bit disappointed. Obviously, it's everybody's individual choice, and you can't force people to go in a certain direction. But I sometimes feel like, why don't you just see how you can manage it once you have actually a child, before you even make that decision? And then if you feel that as a consultant with a child, it's too difficult, there's a part-time model. So McKinsey is actually incredibly flexible. McKinsey also has, child support basically at the offices. They have nannies at the offices and so on. So they really, really support women extremely well. But if you then figure out that even with part-time, for example, as a consultant, because of the traveling and so on, it doesn't work out, you can then make a move into an internal position still. But I feel a lot of women, think about how could I potentially juggle it too early, and then, they take themselves out of maybe not the workforce, but out of the most promising career path they could have had before they even would have had to, And I think that really is one of the main reasons why we don't see more senior partners at McKinsey that are women, because women just feel it'll be too hard for me to juggle. And I think there's still not, for my taste, there are probably still not enough women that just demand an equal share of, childcare from their partner as well. It still very often defaults to the woman, even after like 2, 3, 4 years after giving birth to the child. It's still the woman that just naturally, tries to be the one that is home when the child is sick, that tries to be home earlier than the husband, that maybe, and that's another reason, women often don't participate at networking events or so after work because they want to go home to their family, whereas their husband would have no problem staying longer after work and going out with colleagues or going to some industry event, because they would assume my wife's going to be home and going to take care of the children. And women more often take it on themselves to actually do that. And I think that's another reason why women just build weaker networks as well.
I'd love to ask you a few questions based on your experience starting and scaling a company. What are the most important ingredients for a successful startup?
I think there are several. Obviously, you need to identify a customer need that is unmet and that has a big enough market potential, because you can also identify a need that is just extremely niche. And then you probably can't build a healthy business out of it. So in our case, I think we have that, because investing is something that affects almost everyone. And we've identified an unmet need, which is, more professional, more individualized, more customized investment management. So I think that's sort of the customer need question. Then I think the next step is you need to have the right team. So you need to have a team that has the right experience in order to tackle that problem. And also a team that is complementary. I've seen quite a few startups where you have 2 or 3 friends relatively fresh out of university, or maybe also just colleagues at their current employer. And then they start a business together, but they actually have almost exactly the same skill set. And that's not super helpful. You typically need complementary skill sets. So I think the team composition is very important. Also, the team will help you, the caliber of the team will help you to raise money. Because I also think that there are quite a few companies out there that could have been successful if they'd been able to raise more money earlier. Because you can fail if you just have too little money to show enough traction for the next funding round. So I guess, the team helps with the funding. And then I guess in terms of the funding, it's also important to have the right investors that really believe in what you're doing. And ideally, now, many startup entrepreneurs obviously struggle to get money at all, and they will take whatever money they can get. But if you're in a luxury position where you can choose, then I would also want to make sure that I choose an investor that has deep enough pockets to also help you in the next funding round if it turns out to be difficult to get other investors on board. So you want to make sure that you have an investor that maybe has, like if it's a VC, that they've raised a big enough fund and they've basically set aside some amount of that fund for the next funding rounds of their existing investments. I think that's important. And then I think something that is very undervalued by a lot of other startups is partnerships with other companies. And it's not applicable for every industry sector that a startup could be in. But I think very often partnerships can be very powerful, and they can give you a lot of leverage early on. They can help you reach more customers. They can maybe help you reduce the cost, maybe outsource something that would be very difficult for you or very costly to build, and so on. So I think if you can partner with external companies because there's a joint interest in doing so, I think that's a quite important ingredient as well.
How are you guys approaching scaling? So you've clearly gone through the start the company, raise some initial money, prove a bit of traction. And you're relatively recently off a 30 million euro round. So you're clearly out of the is this gonna work? It's how far can we take this? How is that different? What advice would you have specifically for entrepreneurs who are dealing with scaling challenges as opposed to earlier stage startup challenges?
That's a difficult one, because I guess a lot of it depends on the individual situation. But I think what's important is, and this is in a way, this is something that you need to pay attention to from the beginning as well. I think what's very important is, specifically with regards to your technology, that you build it in a way where you can actually scale, right? Because there are companies that are in a way in the lucky position that what they are offering is being met with incredible demand on the customer side, but then they cannot deal with it. Whether it's an e-commerce company that all of a sudden can't deliver its products to its customers because they have logistical issues, or because they have warehousing issues or whatever, or whether it's a financial company such as ours that all of a sudden figures out that they have actually to do a lot of manual work when it comes to every new customer, and then all of a sudden, if you have 500,000 customers, it becomes totally unfeasible, and you're going to have delays, and people are going to be angry, and so on. So I think it's important that you get your technology right from the beginning, so that you always ask yourself, if we tomorrow doubled our customer base, would that have a real impact, or would we be able to serve these customers just as well as the current number of customers? Yeah, and I think we've built our technology in exactly that way, that we feel it's very modular. And it's very scalable. But I guess when I think about how do you scale further, so apart from can you actually scale, but if the question is, how do I scale? How do I make sure that I grow really quickly? I guess, it's a question of funding. How much money do you have to spend on customer acquisition as well? And that becomes easier if you can show that your unit economics are right, so that you will earn back your marketing spend within a year or two. Then it will become a lot easier to raise the funding required for that. Or the other route, in our case, for example, also is partnerships such as B2B2C partnerships. So that's a very big area. And again, I feel that quite a few fintech companies haven't really looked at that and are really focused on a D2C play only. And I think in order to scale, working with incumbents can be incredibly powerful.
Mm-hmm. One last question before we go. How much do you think investments will change over the next 10 years?
I think it will change a lot, to be honest. I think it will change a lot because the main thing that I think will change is that you will have a lot more people that will have an individually customized and managed portfolio as opposed to people buying standardized funds. So I think funds as a product, they maybe won't disappear within the next 10 years. But I think the fund as a construct becomes less of a modern financial product because the only reason why we needed funds in the past was because if you had, as an investor, just let's say £50 or £500 to invest, and you wanted to get exposure to many different companies, the only way to get that exposure was to bundle your money with thousands of others investors' money and then create a fund that would buy all of those companies for you, right? These days, using technology, there's just no longer a strong need for that type of financial instrument because what we can do instead is we can take your money, the 500 or the 50, we could potentially buy fractional shares in individual stocks or in an ETF and an index fund, basically, and give you that exposure without having to lump your money together with other investors' money. And then we can manage your money in a more individual way. So, for example, in the future, if you were to say, I don't want to have any exposure to, pharmaceutical companies because you don't like that, or, tobacco companies, or companies that produce military equipment, or whatever it is, there would be a way for us to exclude that. And in a fund, obviously, you can't work with any customization at the individual investor level because it's a fund that has to kind of match or be the same for everybody, for every investor. So we could customize in the future using technology. We could also use tax allowances that you potentially have that maybe another investor doesn't have. So we could make adjustments to your portfolio that we wouldn't make for another investor, and so on and so forth. So I think people will get much more used to the idea of having an individual portfolio that is managed for them all the time. Obviously using technology, using automations, using algorithms, because otherwise it's not possible. It's not cost efficient. But I think that's one of the biggest changes that I would foresee. So I think funds will become a little bit less relevant. Individually managed portfolios will become more relevant, and we'll see more customization, which I think all of that is great. And we'll see lower cost, obviously, as well. And I think all of this is fantastic news for customers and for investors.
The whole ICO craze, initial coin offerings in the crypto space, regardless of how anyone feels about that specifically, kind of does highlight the fact that as technology develops, business models change to an extent, more and different types of asset classes become directly available to investors. So in an ICO, you can effectively invest in, you can think about it directly into the kind of equity-like value of an early stage company, which traditionally you haven't maybe been able to do if you're a mass market consumer investor. Do you expect new asset classes and kind of new investment exposures to become available as technology develops over the next few years?
It's a good question. I guess I've not asked myself that question. So I think, what's happening with the ICOs right now, I think is something that we are observing with interest and probably to some level also astonishment as to how much money is going into some of those companies where you sometimes have very little documentation of what they will actually be doing. And I think the legal situation is very unclear in many cases. And obviously the first lawsuits have already started and so on. So our opinion, like for now, basically, we would not be offering any participation in ICOs, but we also wouldn't invest into any of the cryptocurrency funds. Also for the simple reason that there's not sufficient data history available about their performance and volatility and so on for our algorithm to even work with it. But what do we expect to see in the future? I think what we definitely expect to see in the future is more fractional ownership, and I think easier ways or easier access to gain ownership. And as you just mentioned, an ICO is one very particular way of doing that. But I think in general, it might become easier for people to maybe also participate in private equity style deals. It might be easier for people to buy very small fractions of a share of a company. I remember, I don't know what their current price is, but I remember that a couple of years ago, Porsche, the car manufacturer, had an incredibly expensive stock. It cost like 3,000 euros or something for one share. So that was very, very difficult then for investors to get any sort of participation in that company, right? And I think what we'll definitely see is a lot more sort of fractional ownership. So you'll be able to slice it down into much smaller pieces. That for sure. Whether there will be other types of technology investments, difficult to say.
No, I mean it's interesting to think about. Since 2008 more or less, you got peer-to-peer lending, right? So suddenly retail investors can invest in whole loans or fractions of direct loans. Now, ICOs are kind of a similar thing. And again, technology aside, it's a different way of getting exposure to new ventures. I mean, you could even, if you let your imagination run a little bit, Uber could open up like an investment component on its platform. And you could almost like crowdfund, take a small equity stake in a driver's purchase of his new car.
Yeah.
And your investment returns would be linked to that individual's ongoing effectively profitability over time. You would support that individual in kind of gaining a livelihood, and you'd also extract investment returns as a result. It's that that kind of platforms plus potentially things like blockchain where you don't need like the intermediation of ownership and trading, plus these new more fragmented, more granular models. It feels to me like we could start to see some really interesting kind of new, in quotation marks, investment opportunities.
I would agree. I would agree. I think a lot more different types of investment options will come to the market as well. And maybe one additional area that we haven't spoken about yet that could happen in the future would be that the government tries to fund bigger infrastructure projects that can be like extremely expensive, obviously, like hundreds of billions of pounds in cost. They could try to maybe raise money directly from citizens who then get a profit in, let's say, it's whether it's about a new railway, for example, then maybe they're going to raise money through their citizens, actually, and they're going to get a share in that new railway and they're going to participate in the revenue. I mean, that would be a new way to raise money as well for the state. And it would maybe also make sure that there's a very efficient allocation of funds, because it's not sort of someone or some committee in the government that decides about it, but the stuff gets funded that actually finds investors as well. So where a huge group of people seems to believe it's worth putting my money in because this is something the public needs, and the public as a consequence will want to pay for, so that it makes at least a small profit. So maybe that's also a new way. Instead of collecting taxes and then basically deciding for the taxpayer what to do, maybe we're going to see an era where governments are going to collect a little bit less taxes, but then going to raise money directly for infrastructure projects. So all of this could happen in a world where it becomes easier to manage multi-ownership. Because right now, I think that's the problem, right? Very often, having lots of shareholders creates an administrative burden that makes everything extremely cost inefficient. And to your point, blockchain can obviously help to drive down those costs massively. On the other hand, I believe that there is still potentially a lack of regulation around blockchain. And I think for sure what a lot of people feel, a lot of investors feel is missing, is a clear understanding of who can I turn to if I feel something's gone wrong, right? Because we do have cases where money is being stolen out of e-wallets, and there is no authority you can appeal to. So if it happens and you get hacked, your money is potentially gone. I'm not saying that's happening all the time, so I don't want to scare anyone, but if it happens, you'd feel like, where do I go? Do I go to the police? I can't go to my bank because there's no bank in there? Like, who is it? Whereas if you have an Amex and there's a transaction on your credit card bill that you are sure has nothing to do with you, you call Amex and they will take care of it. And it's great for people to know that, right? And I think with blockchain, there's still, obviously, I think there's a lot of confusion for many people. What is it actually? And so on. It's all very abstract for people. But apart from, do I understand how it works or not? I think many people have that question. What if things go wrong? Who do I turn to? Is there a court that will make a decision? Is the police going to be involved? Is there some other authority? Does the regulator care? I think that type of insecurity around what your rights are and who you can appeal to, basically, I think that's something we need to get a grip around.
Mm. I suppose one of the other massive questions in all of this is, what role will humans play going forward in all this? You guys are automating so much of the investment management process. Traditionally, it's been human investment decision making. Mm-hmm. Will that be the case in the future? Is that what we want? Does that produce optimal outputs?
So I think when it comes very specifically to investment management, there is so much evidence that humans are flawed as investors. There's so many human biases that we have, loss aversion, which is basically, that the fact that when you've invested into something and it starts to make a little bit of a loss, you don't want to realize it, because that would be admitting that this was not a good investment. So you just close your eyes, so to speak, and you hope that it's going to become profitable and it's going to turn around. And then at some point you panic when it's like minus 20, for example, minus 20%, then you're like, oh my God, I'm going to lose everything. You panic, you sell, right? So this loss aversion is not rational, but we have it. And it's very difficult to fight against it, even for institutional investors. There's plenty of research that also shows that professional investors working for big institutions, people that have been fund managers for 30 years, they still have these biases. We are all subject to trends and herding behavior as well. So and we can see it perfectly with, cryptocurrencies, because we just spoke about it, right? At some point, there's a tipping point where all of a sudden everybody's talking about it. Everybody knows, how much Bitcoin has appreciated in price. And so many people are getting in at a point where maybe it's the peak already. So we do this herding thing, which is not rational. It doesn't have anything to do with facts. It's just that we have a gut feeling that it's a thing right now, and you should be in it, right? So there's plenty of evidence that humans don't make rational decisions when it comes to investment management. And also there's plenty of evidence about how you can make better investment decisions, looking at data and analyzing data. So using that data and then making unemotional, very rational decisions can definitely lead to better output. So there I'm very confident. When it comes to sort of the bigger question, is it scary that we automate so much? And what's going to be the role of humans in the future? I'm actually quite optimistic, because I feel throughout human mankind, basically, we have always developed ways to become more efficient, to automate things, from the earliest tools that we've built that have allowed us, to hunt more animals, to the Industrial Revolution, where all of a sudden we would be able to weave fabrics, meters and meters of fabrics super quickly, where before it would have been a painstaking process. Down to today, where we're going to have self-driving cars and so on. We always were able to find new jobs for people to do. Jobs have always changed. There were jobs in the Middle Ages that just do not exist anymore. People don't even know anymore what that was. We found new jobs, computer scientists and so on, who weren't there 100 years ago. So I'm quite optimistic. I think we people are very, very good at adapting to new circumstances. I think, unfortunately, we sometimes underrate our capability in that respect, and we are fearful. But I'm actually quite optimistic that it's just going to lead to better efficiency and more wealth in the end for more people.
Well, I agree with you 100%. I think there's sure risk of disjointed kind of intermediate term between where we are now and where we are next. But the idea that humans are going to be rendered irrelevant in the labor force, just not going to happen.
And I think if I may add one thing, I think it's also because there's a lot of confusion, or this fear also exists because there's a lot of confusion around the term artificial intelligence. Yeah. Because I think there are people that when they hear the term artificial intelligence, they literally think about, like that movie Ex Machina, where you really create a person that can think and act like a human being, and you can't distinguish it from a human being anymore. And then there's this fear, oh my God, are we about to create that person? And then will those artificial people take over because they're going to be smarter than us and, more ruthless than us and whatever? But that's something that is so far away, I believe. What we are talking about most of the time when you read about artificial intelligence in the press, or when we internally speak about artificial intelligence, is more like machine learning, basically, like improving things, having, self-learning algorithms, basically having processes that try to improve themselves. It's not about conscience building, basically. And I think once you make that clear, a lot of people become, I think, more comfortable with artificial intelligence. Once they understand that it's not about like a duplicate of themselves that's going to replace them, right?
Look, we could keep going for hours, I'm sure. But I'm conscious that I told you maybe 15 minutes ago that I was asking my last question. So I think it's time I let you go. Ella, what's the best way for people to find out more about your work and connect with you directly?
So you can follow me on Twitter. My Twitter handle is Ella_Rabener, so Rabener. You can follow Scalable on our Facebook pages. We have a Facebook page for our international presence, so in English language, and we have a Facebook page for Germany as well. We also have Twitter handles, so Scalable Capital. You can find us on Twitter as well. Or send me an email. My email is ella@scalable.capital.
Great. Ella Rabener, thank you very much for joining us today.
Thank you for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.